Hi there guys, and welcome to another Bookit accounting topic video. My name is Prince Mohalu, and today we will be looking at the conceptual framework, which basically governs the accounting equation. For ease of reference, you can have a look at this book, which is the conceptual framework as published by the International Accounting Standards Board. In part 1, we will be dealing with the background of the conceptual framework, which speaks about the purpose, as well as chapters 1 to chapter 3. In the second part of the video, we will be dealing with chapter 4 to 8 of the conceptual framework. Starting off with the background of the conceptual framework, this essentially speaks to why the framework is important. And it is to assist the ISB in developing the IFRSs. It is also to assist the preparers of financial information with developing accounting policies that are consistent with the principles found in the framework. And this is important, especially when dealing with transactions that are a bit gray and they aren't really detailed guidance provided by the IFRSs. The conceptual framework can then be used in developing the accounting policies. It also assists all parties to understand and to interpret the IFRSs. Please note that the conceptual framework is not a standard, and so where there are differences between the conceptual framework and the IFRSs will always prevail. Chapter 1 of the conceptual framework deals with general purpose financial reporting. And the objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions to provide resources to the entity. The primary users of general purpose financial reports include investors, lenders, and other creditors. It is important to note that management is not a primary user, and this is because at any given point in time, management has access to the internal records which they can use to make decisions. Information contained in these general purpose reports shows the entity's economic resources, the claims against the entity, and changes in these resources and claims. It also assists in assessing the entity's liquidity and solvency, the needs for additional financing, and how successful it is to obtain financing. Chapter 2 of the conceptual framework deals with the qualitative characteristics of useful financial information, which is broken down into the fundamental characteristics being the most critical, as well as the enhancing characteristics which are highly desired. The fundamental characteristics are further broken down into relevance, as well as faithful representation. For financial information to be relevant, it needs to be capable of making a difference in the decisions taken by the users of financial information. It would need to have predictive value, confirmatory value, or both. It would also need to be material, and it is material if omitting or misstating it could influence the decisions taken by the primary users, and materiality is based on the nature, magnitude, or both. So it could happen, for instance, that a transaction might have a small monetary value, however, because of its nature, it is material. For example, a legal claim. Financial information would also need to be faithfully represented, and this means that the substance of the transaction would need to be faithfully represented. For financial information to be faithfully represented, it needs to be complete, it needs to be neutral, as well as free from error. Moving on to the enhancing characteristics of financial information, we look at comparability, meaning that financial information needs to be comparable between different entities and different periods. It also needs to be verifiable, meaning that different knowledgeable and independent observers could reach consensus that faithful representation has been achieved. It also needs to be timely, meaning that financial information should be available as soon as possible. And it goes by the principle that the older the information, the less useful it is. It also needs to be understandable, meaning that it needs to be presented and explained in a manner that is easy to understand. Chapter 3 of the Conceptual Framework deals with financial statements and the reporting entity. Please note that Chapter 1 and Chapter 2 deals with general purpose financial reports, whereas Chapter 3 to Chapter 8 will deal with general purpose financial statements. And the objective of general purpose financial statements are to provide information about the entity's assets, liabilities, equity, income, and expenses that is useful to assess the prospects of future net cash inflows and management's stewardship of the entity's resources. In other words, assessing how management has effectively utilized the resources of the entity. The information contained in these statements include the statement of financial position, which includes the assets, liabilities, and equity of the entity, the statement of financial position, which includes the income and expenses of the entity, the statement of cash flows, the statement of changes in equity, as well as the notes. Chapter 3 of the Conceptual Framework further speaks about the reporting period and provides guidance on this. And the reporting period, it should present the assets, liabilities, and equity that existed at the end of the reporting period, the income and expenses for the reporting period, as well as comparative information to be provided for at least one preceding reporting period. Chapter 3 also provides guidance on the perspective adopted in the financial statements. And it states that transactions are viewed from the perspective of the reporting entity and not from the perspective of any particular group of investors, lenders, or other creditors. It also provides guidance on the going concern assumption, where it states that the financial statements will be prepared on the going concern basis as the entity will continue to operate for the foreseeable future, which is usually 1 year. However, if the going concern assumption is not applicable, then the financial statements will be prepared on another basis, i.e. the liquidation basis. Chapter 4 of the Conceptual Framework deals with the elements of financial statements, and it provides a definition of the elements of the financial statements. An asset is defined as a present economic resource, which is a right that has the potential to produce economic benefits, which is controlled by the entity and as a result of past events. Liabilities are defined as a present obligation, being a duty or responsibility that an entity has no practical ability to avoid. To transfer an economic resource, which is cash, goods, services, financial instruments, amongst others, and which is as a result of past events. So, this has already been obtained, being the economic benefits, and consequently, an economic resource has to be transferred. Equity is defined as the residual interest in assets after deducting all its liabilities. Equity therefore comprises of claims that do not meet the definition of a liability. For example, ordinary shares. Income is defined as increases in assets or decreases in liabilities that results in increases in equity other than those relating to contributions from holders of equity claims. Expenses are defined as decreases in assets or increases in liabilities that result in decreases in equity other than distributions to holders of equity claims. Chapter 5 of the Conceptual Framework deals with recognition and derecognition and is split into 3 criteria or 3 parts. The first part would focus on the recognition process, the second part focuses on the recognition criteria, And the final part would focus on derecognition. In relation to the recognition process, this is essentially the process of capturing items that meet the definition of element for inclusion in the statement of financial position or financial performance. In relation to the recognition criteria, this focuses mainly on relevance as well as faithful representation. In respect to relevance, the conceptual framework provides guidance on instances where recognition will not provide relevant information and focuses on existence uncertainty together with the low probability of inflow or outflow of benefits. So this is where an asset or liability does exist, but the probability of inflow or outflow is low. In relation to faithful representation, we look at the measurement uncertainty. And it is mentioned that estimates are a normal part of financial reporting and does not affect its usefulness. However, clear and accurate description and explanation is needed. There's also focus on the resulting income, expenses, or equity, the related assets or liability, as well as presentation and disclosure. Derecognition focuses on the removal of all or part of a recognized asset or liability from an entity's statement of financial position. An asset is normally derecognized when control is lost, and a liability is normally derecognized when there is no longer a present obligation. Chapter 6 of the Conceptual Framework focuses on measurement. There are different measurement bases as stated by the Conceptual Framework, one of which is historic cost. The historic cost of an asset is the consideration paid to acquire or create the asset, plus any transaction cost. The historic cost for a liability is the consideration received to incur or take on the liability, less any transaction cost. The second measurement basis is current value, and this can be broken down into fair value, value in use or fulfillment value, as well as current cost. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The second measurement basis is current value and can be split into fair value, value in use, or current value. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Value in use for assets or fulfillment value for liability. So, for an asset, the value in use is essentially the present value of expected cash flows from use of the asset and ultimate disposal. The fulfillment value for the liability is the present value of expected cash flows to fulfill the liability. The current cost of an asset is the cost of an equivalent asset at measurement date. So this is the consideration paid on measurement date plus transaction cost. And the current cost for a liability is the consideration of an equivalent liability at measurement date. So this is the consideration received at measurement date less transaction costs. Chapter 7 of the Conceptual Framework focuses on presentation and disclosure. An entity communicates through presentation and disclosure. Effective communication of information in financial statements makes information more relevant and contributes to faithful presentation. It also enhances understandability and comparability of information in the financial statements. Effective communication requires focusing on objectives rather than rules. It also requires the classification of items in a manner that groups similar items and separates dissimilar items. And it also requires the aggregation of information. And this essentially means not having too much detail, but also not having too little detail. We also need to consider cost constraints, and this simply means that the benefits should justify the costs. Chapter 8 of the Conceptual Framework looks at capital and capital maintenance. The concept of capital can be broken down into two concepts, one being the financial concept, which is the net asset or equity of the entity, and the second being the physical concept, which is the productive capacity of the entity. For example, units of output per day. The concept of capital maintenance essentially means that the entity seeks to maintain its capital, and profit from the perspective of capital maintenance. For financial capital, this refers to the net asset at the end of the period, which exceeds the net assets at the beginning of the period, after excluding contributions from or distributions to owners. And for physical capital, this refers to the physical productive capacity at the end of the period, which exceeds the capacity at the beginning of the period, after excluding contributions from or distributions to owners. Thank you for joining us today. We trust that this video will serve as an aid to prepare you for this topic. If you'd like to get the maximum value from our video series and for your studies, join our Facebook group for accounting students by scanning the QR code on screen or by finding the link in the description. This group is filled with verified tutors and other members that will answer any questions you might have for accounting, tax, audit, and financial management. Remember to subscribe to our YouTube channel for more videos that help further your studies. See you soon.